Thanks for tuning into Talking Point. I'm your host, Neeraj Shah. On the show today, we have Andrew Holland of Avendus Capital. He needs no introduction. And we will be talking to him about a bunch of things. Not the least of all would be the current market sentiment, of course, and how that is shaping up. But we will also talk about the key points around the China opening up theory and what does it do for the Asian markets. Does the strong US jobs data mean that the rate cut assumptions go down? We'll talk about whether banking stocks are a good buy at the current valuations. Does Midcap IT offer value after the run-up that we've already seen? Well, IT has been arguably the strongest performing sector in the month of January. And then if he has a view on the Adani Group stocks as well, and whether they can make a difference to the market sentiment, if at all. Let's get him in on the show. Andrew, great having you. Thank you so much for taking the time out and being with us on Talking Point today.
Thank you, and it's a pleasure as always. Thank you for having me.
I know the pleasure is ours. Andrew, let's start off with the most recent market impacting development and the US jobs data in Friday's session. Much stronger than anticipated. Now, the Fed is tired of telling the market that, hey, follow me and don't preempt rate cuts. The market has done the opposite thus far. Does this jobs data, and if some more data like this comes about, does it change that narrative or change the behavior of the market?
It's a great question. I think it's something we're all pondering over. But I think with that jobs data, I didn't see that there was very much wage growth, and I think that's the key, right? So maybe because demand has remained more resilient than maybe we were expecting, employers have kept people on or kept people in their jobs longer than we were thinking. But I do think the Fed still has it wrong. I think we will be thinking about deflation. Inflation will start to come off from here, and I think that's really kind of baked into the two things. One is the bond yields, where they really haven't been rising. So we still think the terminal rate is 5%. But I think if some of the inflation data is a little bit more kind of bullish in terms of that it's falling, then the question mark over whether the Fed will go on hold by March will continue. And I think that's played out a little bit in the dollar. The dollar's weakened quite considerably. The DXY, is kind of touching at 100 level or near to 100 level. So that's indicating that the market's sniffing out that the Fed is wrong, and they will have to pivot at some point in the first half of the year. So I think that's what the market's playing out. I think data will be, data is always the problem, is that it's always a little bit rear view mirror. And therefore, I think the recession in the US, or the downturn, started probably last October, November. And we'll start to see that reflected in some of the inflation data that comes through. But generally overall, I'm surprised that the level of the consumer confidence, not just in the US but globally. I mean, even in Europe, it's still holding up. So at some point, it will start to wane. But it's just not playing out right at the second.
Okay. Andrew, the other point would be whether markets, will they be a bit skittish in the near term due to geopolitics? I mean, the Chinese, presumably Chinese balloon notwithstanding, or the Russia-Ukraine and 1-year anniversary coming up notwithstanding, we see increased geopolitical chatter. We're seeing some technical issues as well with the market, resistance levels which the market is failing to break. Does that make the market susceptible in the near term?
Yeah, I mean, listen, I think the market, I would say since October of last year has been trying to has been going through a bottoming out process, which is why we haven't seen any sharp falls from where we have been prior to that. But some of this data, as you mentioned, the jobs data or geopolitical, could have the markets just heading down in the short term, because it is baking in a more Goldilocks scenario that growth is holding up and inflation's coming down. Therefore, you have that soft landing. So we will go through bouts of pessimism as well in terms of some of these factors. I think that the China and the balloon thing is probably not the catalyst for markets to fall. I think we'll get through that one. But I do think that some of these factors will just weigh on the markets. But the thing I look at is that if I look at the rally in the US, it's been led by the tech stocks, which tells me the market is sniffing out that Fed pivot. And if that's the case, then a lot of money will move towards the kind of growth stocks which got beaten down quite considerably. And you've seen that in some of the results, which have those results and profits were lowered quite considerably. But any beat or any kind of optimism around them has led to very sharp price rises in tech stocks, and that's really helped our IT stocks as well, which we talked about this many times, is that the correlation remains high. So if you think that the Fed will go on hold and growth stocks will come back, then obviously IT will have a favourable tailwind going forward. In terms of share price performance, and that's what we've been seeing.
Yeah, well, every IT stock in India would be hoping that their fortunes are as good as Meta's fortunes in the recent times. Andrew, actually, so let me stick with that then, or maybe first the India market and then the specific things within India too. Now, in wake of the fact that US tech is not as expensive as it used to be, and that China, despite the run-up, is still not expensive compared to its averages, do you think flows into India, despite the correction, might be sedate because global money will find favor in both China, US, and maybe some other areas?
So, if we're correct that the Fed goes on hold, our long-standing view, and again we discussed this previously over the past year, is that when people look for growth, they're going to look to emerging markets, because you're going to be saying that the world will recover and emerging markets will be a beneficiary of that. So there's two parts to that. One is obviously when looking at emerging markets, the relative valuations are much more favourable towards, say, a China, Korea, Taiwan than they are to India, because our markets held up very well last year, one of the best performing markets. So what I think will happen is any emerging market fund that receives money, I think they'll allocate more towards a China, Korea, Taiwan, and probably underweight India. So we'll still get money, but it won't be the kind of the large amounts that you would expect given our weightage in the indices. So that would be my guess, at least in the first half, and until either our valuations have kind of compressed a little bit more, or the valuations of the other countries have started to move higher. So that's, I think, that the first part of it will be that flows will be okay, but they won't be disproportionate than we would have thought. So going into 2023, and I think China reopening changed that narrative quite a lot, because obviously China reopening is good for a lot of exporters into China, including Korea, Taiwan, and Japan. So that's where you can see the flows within Asia as well, kind of being consolidated towards those countries.
So India negative, India neutral, or India constructive? What is Andrew Holland currently?
So I think it's as usual, it's a little bit of first half, second half. I think first half will continue to be those exporting countries like China, Korea, Taiwan, which will probably benefit from the flows. But as we go into the second half of the year, I think that it will start to pick up for India because of two things. One, I thought the budget was very good. It ticked all the boxes, I think, for most people in terms of capex expenditure. by the government, but also the fact that consumption has been given a bit of a kind of a kick upwards as well in terms of some of the tax reductions at the top end. So I think that's a healthy combination as we go into the back end of the year, and I think that's where you'd see, to my mind, earnings upgrades maybe starting to come through as well as the economy really starts to move ahead, given these two factors. So that would, I think, bring in more flows in the second half. So that's how we're thinking at the moment. So it's not a bad year overall, don't get me wrong, but it's not. It's maybe not the stellar year that people were thinking coming into 2023, partly because of valuations.
Makes sense. Okay. I think the last 10 days, aside of the budget, what caught the imagination obviously was the whole Hindenburg report impact on Adani Group stocks and the resultant impact on sentiment, Andrew. Now, I don't know if you have a view on, not from a buy-sell perspective, but what it does to what is arguably a fairly large set of stocks in India, 8-9 group companies out there, some index names, and to the resultant impact on the sentiment, if not a view on the Adani Group stocks. Do you have view on either of these two because of what's happened in the 8-9 days?
So, the sentiment-wise, I think, I mean, the market, despite what's been happening, has been very resilient. So I'm not worried about that. I suppose what happened in terms of sentiment is that coming into 2023, and you'll remember this in December, that because of China's problems, India was the shining star for everybody in when we were talking. And that's just been dampened by some of these factors. But I mean, that's all. I mean, India's growth will continue. All the factors that the budget was there. So, these things will blow over in my mind. So if anything, it's an opportunity, given that valuations again have contracted because of it.
Yeah.
It gives you a good entry point. But, if you look at the results season and the performance of some of the stocks, I mean, they've done very well. So it's really, just I think a technical factor for the markets just to get over in the shorter term. But otherwise, the kind of the resilience of the index itself has been very, very strong.
Andrew, you spoke about how, I mean, the last 7-8%, 9% corrective move, or maybe less than that now, also resulted in the banking stocks coming under pressure. Now, the numbers were almost rock solid for all the banks. The skeptics have an argument that coming up, we'll see NIM compression. Valuations aren't exactly the cheapest. So is the best of the banking gains behind? And should we look at other pockets? Whereas the optimists are of a counter view that the absolute numbers will keep on growing at a good pace, even if there is a NIM compression. Now, my question is, how are you looking at the BFSI space at large? So banking and beyond.
So banking, we've always had, as you know, it's always been on our radar in terms of not just the kind of growth that you've been seeing, but also because of that deflation trade, which we think will play out sometime this year as well. But the results were stellar. I mean, if I think back to Uday Kotak saying it's a Goldilocks scenario, he was bang on, right? So, but I think even with that, the results have surprised the street and the analysts, and we've been seeing upgrades. I think the key now in the very short term is what the RBI does. And it's not necessarily whether they're going to go for 25 basis points or not. If not, then it's obviously very positive. But if they change their view from being, kind of a bit hawkish to more accommodative or more neutral, I think that's what will get the market, very, very excited, and therefore the leg up in the financial sector, I think will have another, kind of a way to go on the upside, and probably a little bit more concentration towards non-bank financial companies is probably where some of the money will go into. If the RBI this week a bit more accommodative in their stance, which they should be.
Yeah, that seems to be a change in the narrative of late. The last 5 years, I've heard a bunch of people who are constructive about banks saying that now they're starting to look at NBFCs. and not just restricted themselves to bank. And that's Andrew Holland's view as well. Andrew, you spoke about information technology, and that brings me to my next question. There is a bit of a, so no longer at the Nadin, no longer at the peak, a bit of a rally, maybe on the back of, as you said, the US tech space doing well. What does one do with Midcap IT? Because, I mean, the reason I ask this is because, for example, I'm just using it as an illustration. Uh, a Midcap IT name or an ERD company name, KPIT, Tata Elxsi, strong numbers and a massive reaction thereof. So it's not that people are not liking expensive mid-cap IT names. Persistent, KPIT, a case in point. So no longer at the cheapest valuations, but not as expensive as they used to be. Are they giving you an opportunity, or would you shy away?
Yeah, if I'm going to go into IT, I'm going to go into the mainstream companies first,
Okay.
because I think that's where the value lies, and they've got very strong balance sheets. So I get a bit of safety as well, just in case things have that kind of, and not have that kind of in terms of volatility within the tech sector. I'd probably be in the larger stocks rather than the mid caps at this point of time. Because the evidence has to come through, right? I mean, we're seeing it in stock prices, but you need to start to see that the growth stocks or tech stocks in the US, are starting to grow again. And I think that would be the confidence I'd have, maybe to look down from the large caps to the mid caps at this point. But I think it's just I'm not saying it's risky. I just think it's safer to be in the larger caps at this moment.
Okay. Okay. Point well taken. And Roland, my final question: what has impressed you, or where is it that your bias is the strongest currently? Be it due to the budget, be it due to the recent earnings season, the delivery from a specific sector or a theme thereof, or be it that in some theme which you've always liked, the valuations have become a lot more reasonable. So either of these three, but where is it that you are the most constructive on currently?
The themes haven't changed, coming into this year. If anything, they've been reaffirmed by the budget. But if you remember, Raj, we said that the two big global themes are defense spending and renewable spending, and that's not going to go away. So that's going to happen. We've always said that, look at India, in the services sector, in terms of consumption. It's going to be, the hotels, travel. That's going to continue. That's a big theme that will continue to play, and the emphasis by the government on, making more tourism destinations, I think only plays into that kind of, kind of local travel. Why go overseas? It's very expensive at the moment to do so. So travel in India, I think, will continue, and I think our view that capex cycle, private companies, looking at areas where there's either security problems in terms of supply, or kind of trying to move away from China, will be a continuous theme. So the ABBs and Siemens of this world will continue to do well, and obviously railway spending is going up as well, so that helps those companies. And I think one area which we talked about is electronics. I do think that's going to be a big factor going forward, not just supplying in India, but globally going forward as well. So I think that's a big new industry which is going to emerge over the next 2 to 5 years. So that's something to look forward to. So no real big changes in themes, and banking obviously plays into our deflation. We're of the view that the Fed's got it wrong and we'll have to pivot.
Well, on that note, Andrew Holland, take a moment to thank you for joining us today and giving us all that wisdom. Really appreciate your time.
Thank you. Thank you for the opportunity, as always.
The pleasure was ours. And viewers, some key takeaways: very constructive on banking even now, and some of the last answer had some themes that Andrew Holland really believed in, and tourism and hotels doesn't surprise. Like, look at the Indian hotel numbers, and that will tell you a story or two about the strength there. And of course, in IT, the slightly contrarian view that he may have is that, or maybe it's not contrarian, that stick to the safety of the large caps, because tech may not necessarily be out of the uncertainty zone currently. Hope this interaction was useful. Thank you so much, as always, for tuning in to Talking Point.